a lot of people maybe watching this may be a bit nervous about inflation, but the reality is inflation is completely normal.
Yeah. In the UK, we've seen a cabinet reshuffle over the last couple of days. Has that had any effect on UK markets? When we got the brief for this week's podcast, Graham said you'd like some laughs and banter. So we invited Paul along. Good morning, everyone. Welcome to the True Potential podcast. This is Do More With Your Money number 86, and today is Friday, the 17th of September. I'm joined this morning by colleagues from the investment management firm. We have Jeff Casson, Paul Durrans, and Chris Leyland. Chris and Jeff, you'll know well from previous broadcasts. Paul,
relatively new on the podcast front, but I think this is my third appearance. So.
Welcome.
See how we go.
Welcome.
Thank you.
Paul, in a moment we're going to look at the markets, what's happened this week. But before we get into that, I just want to follow up on last week's podcast, which had a theme of the Great North Run. We had runners from True Potential, from the staff. We have sponsorship from many, many people. And we're hoping today that we'll be able to close that at £6,000. Which is a fantastic amount. Fantastic. And True Potential will double that as well. So £12,000 going to the Sunshine Fund, which is a fantastic cause. Just to let you know some running times out of the True Potential staff. Adam Anderson was first. He did 1 minute 41. Ben Braben 1:48 and Dan Harrison at 1:54. Right at the other end of that, we have a lady who came in at 2:38, blaming Prosecco for the time. So
typical.
It has an effect, Paul, and it did. Okay, Paul, moving on to the markets this week. There's been plenty of data, but not a great deal of activity.
No, absolutely. Lots and lots of data this week. But if we look at equity market returns just for the week, we saw really strong gains for Japan. That was up 1.1%, continuing the momentum that we've seen for the past month, really. And that's just based on the Prime Minister saying he's not going to go for re-election again, and that's really buoyed the markets. But elsewhere, we haven't really seen much movements. The UK flat over the week. US slightly down, but pretty much flat. We've seen a little bit of weakness in China, continuing to see that regulatory concerns. In the bond market, we saw bond yields in the UK push higher, and that was on the back of the inflation numbers that came out, 3.2% on Wednesday. In the US, flat over the week. We've seen a bit of movement within the energy complex, so we've seen oil push up 3.5%, and a bit of strength in the dollar as well, but relatively quiet given how much economic data we've had.
Okay. Paul, again, just looking at what you've been up to this week, yes, you've been watching the markets, but you've also been investing within the True Potential funds.
Absolutely.
What are the areas you've been looking at there?
Yeah, so given the regular cash flows that we get in, we have to allocate those within the portfolio. So we've just been topping some of those areas that we prefer, the likes of Europe and the likes of Japan. In Europe, we've been targeting our Baillie Gifford European Growth Fund. And then in Japan, we've just been adding to our passive instrument there. We've also been adding to alternative assets, so not just stocks, not just bonds, but alternatives. So we've been buying a new trend strategy. Basically what that is it's looking for price trends in the market and then looking to capture and benefit from those trends. So that's
momentum driven, Paul.
Yeah, very much momentum driven.
Good. You mentioned Baillie Gifford there, and the reason you're doing that is to get active management within the fund, so they'll be targeting key areas within Europe. Yeah,
we're looking to. We see benefits of going active and passive, and Baillie Gifford's been a very good active manager for us, very good stock picker over the very, very long term, and is continuing to deliver great results for us.
Thank you. Jeff, this week, what's stood out for you?
I think as Paul's alluded to a lot of the data, so we've been looking at the inflation numbers and thinking about inflation across various different markets, and just really this point that we've been talking about, Morning Markets, the podcasts around the direction of travel for inflation over recent months. Clearly, we've seen very significant rises in inflation, some of the bottlenecks working their way through, certain areas of the economies being very robust, leading to very strong inflation levels, but starting to see maybe some of that come off a little bit, which has been good to see in the case of the US. But as Paul's mentioned there, we saw the surprise in the UK with that real kick up in inflation from 2% in July to that 3.2% that we saw in August. So quite a big step change there. And whilst maybe at the 2% in July, we thought it was maybe giving the MPC a bit of freedom. Certainly they don't have much freedom at 3.2%, and maybe we're getting closer to that expectation of a slightly higher inflation rate. So that's certainly something that we've been thinking about, but also discussing with our managers. We've been going through our calls this week, so it's been a real key topic of discussion with them. Also getting their sense of how inflation's likely to evolve over the next 6, 12, 18 months, which is crucially important for many asset classes. So that's been a real key focus for ourselves this week.
Yeah, and earlier in the week when we were looking at the reports, there was a lot of activity around house builders. And, the markets are often driven by news anticipating what's going to happen. And there was a link between the post office and Amazon there, which helped the post office share price rise.
No, there was, you think about it, you look at UK retail sales this morning, the online component of that still remains exceptionally strong, continues to grow, it's well above pre-pandemic levels, it's continued to increase. That distribution that we need for that online purchases that we all make as part of our standard now, as opposed to something that we maybe did on a less frequent basis, really needs delivered. And the opportunity, I suppose, to reinvigorate the post office might be a welcome sign for a lot of people. Where I live, it's hard actually to find a post office.
Yeah.
So if we can actually see that being, and why is that? Because some of the services aren't there. But you bring a relationship like that, well, it might give people the opportunity to think about, well, actually taking a franchise for a post office could be a sensible thing to do.
That's the thing, the post office was the centre of the village, the town at one stage. Now it's tucked behind baked beans or off-license counters and things like that. And I didn't look at you for any reason before I said off-license there, Chris.
Was that all baked beans?
It must be baked beans,
Well, actually, if these microphones are sensitive enough, they'll pick up Chris's stomach rumbling. So if anybody sees me smile on camera, it's because I've just had another message from Chris here.
I'm hungry. Feed me.
Well, Chris, the work that's been done this week, you've been speaking to managers, you've been speaking to the investment partners that we have. What's been coming out of those calls?
Yeah, sure. So maybe just taking a step back, what we do as part of the True Potential portfolio proposition is we keep in constant contact with our managers, and certainly compared to anywhere else that I've worked before, we have much more contact with the managers overall. And the reason why we do that is we want to understand what is their view around markets and how is that then playing into the decisions that they're taking overall around the funds that they run for us. But I guess just thinking about the calls that we've had this week, really a mixture of topics, but I guess just at a very, very high level, I think our managers remain positive on risk assets overall. So the areas that they're favouring are equities, and they tend to be overweight equities. But why is that? I think there's a few reasons in there. Firstly, they see strong economic growth coming forward this year into next year. So that's US, but also regionally as well. I think we talked a little bit about inflation, and we know inflation right now is higher compared to what we've seen in the past. And there's a lot of reasons for that are generally quite pandemic related overall, or to do with supply chains. But I think the reality is that our managers believe that inflation, the higher levels of inflation, will be transitory overall. I think as well as that, you've got quite a strong consumer. You've got a consumer sitting on, I think the global figure that I had was $5.4 trillion worth of excess savings. So that's savings above what they would normally have as a trend. So that means there's a lot of pent-up demand there as well. I think as well as that, you're seeing better vaccination rates come through. You're seeing more and more regions starting to take up the vaccine overall. So I think in reality, you've got what I feel is actually quite a positive environment. There are risks to that, as there always are, but the reality is right now they feel it's quite a positive environment for risk assets. I think outside of that, we talk quite a lot around China, we talk quite a lot around Japan, and I know we'll probably focus on that a little bit later, but I guess just as a starting point, that's really what we're thinking right now.
And there's been a shift as well, or just a slight shift, I would say, in central bank policy, or perhaps the perception of what central bank policy should be. Is it controlling inflation, or is it getting full employment going again? And I think that from what you were saying earlier, before the podcast, it appears to be that returning to full employment might be the short-term goal of many central banks, and we've got central banks meeting next week as well.
Meeting next week, and I think it's an interesting sort of challenge for central banks in terms of them thinking about that dual policy mandate and how that works its way through in different regions of the world. And if we think about just even in the US, where we still have some 7-8 million people unemployed that need to come back into the system, so there's a lot of scope for people to come back before the central bank may think about changing rates. Now clearly the other side of that is that we've seen over the course of time the view that with the Fed last year, the ECB this year, changing how they think about that inflation target. So not thinking about it as a hard number, but thinking about it as a range around that. So with the Fed last year moved to flexible average inflation targeting, and then with the ECB this year moved to asymmetric movements around that 2% level. Interestingly, they've all aligned around 2%, which we can debate whether that's the right number or not. And as Chris has alluded to there, some of the managers thinking that we might settle in the US at a slightly higher level than that 2% for the coming months.
Yeah, and it comes back to market principle of supply and demand, doesn't it? Because there's so much pent-up demand now that manufacturers and suppliers can pass the cost on to the consumer, and that's going to be seen in the inflation figures as well.
I think that's right, and the thing that brought that really home to myself this week was the you look at retail sales and a number of economies. You look at the US, they're 17% ahead of their pre-COVID levels. The UK numbers today, we've got retail sales that are about 5.5% higher than they were pre-COVID.
Yeah.
So we've seen real strength in consumption coming through, particularly in the US, where it's been really buoyed by, and this is where I suppose there's a debate, has the fiscal support been too much in the US, that retail sales have been exceptionally strong. But then that's good for corporates. Corporates have been able to earn. Corporate earnings have been exceptionally strong. Corporate profit margins have been really, really high. And I suppose if we think, where does that potentially lead us to? Strong balance sheets, further investment by these corporates, positive for economic growth over the medium to longer term as well. So there's a push and pull of inflation.
Yeah.
And it's what is the level that the central banks are comfortable with, and how do they want to move that forward from a tapering, as it's been discussed, or a reduction of the support that they've got in markets.
I think the other thing is, we all read headlines about inflation, and a lot of people maybe watching this may be a bit nervous about inflation, but the reality is inflation is completely normal. The Bank of England have a 2% inflation target. It's normal for things to be more expensive as you move through life. It's normal for your wages to move up as you move through life. It's just it's part of life. And I think the reality is that when we look at inflation, inflation right now is higher than what we've seen for a very long time. But there's a good reason for it. It's because of the pandemic, and it's because of that cratering in prices that we saw in February and March last year. But the reality is that even if we do move to an environment of 2-3% inflation, the Bank of England, it has a 2% target.
Yeah.
Inflation is normal. And I think the other thing around inflation is, and this is something that I think is really, really important, is that it really makes you think about where you're invested. You know, the reality is if you're in cash, you know, what's the best rate on cash now? Maybe 1% plus a little bit, something like that, and that really is the very, very best
if you
rate.
can find that, can you let us all
I
know?
know, yeah. That's probably quite a big lock-in. I'll drop that down, make it 0.5%. But you know, the reality is that if you have inflation at say 3%, then what's happening there is that your savings are being eroded. You know, the reality is you have to invest in risk assets. You have to invest in investments to actually make money now, and that's exactly what we're doing with the True Potential portfolio proposition.
And that was a subject we covered in the last edition of True Insight, because we were getting quite a few people asking about inflation. You know, will it be rampant? And the view was no, this is transitory. And you know, the one that brings it home to me, I'll look at you again, Chris. It's part of like the shortage of chips.
Yeah,
but
you're good with your jokes today.
but not the type of stomach rumbling. You know, the microchips in the automotive industry. It's resulted in a 31% increase in used vehicle prices in the States. And that feeds into the inflation figures. So when we talk about supply line shortages, there's one real example. But there's other factors as well which are boosting the inflation figures in the UK, and you know, we touched on it just the other day, Jeff, with the government support for the hospitality industry, which was, what was it, Eat Out to Help Out? The effect of that is feeding in now.
Yeah, and it's all of this.
Jeff, that was another joke, feeding in.
Just didn't pick up on that too early for me, sorry. But I think it is a really fascinating topic, because it's the challenge of how do you forecast in this environment. And you see a headline, 3.2%. Oh, dear me, that's quite high.
Yeah.
But you need to look into the data and think about why that's the case. And the Out to Help Out last year was very deflationary for the restaurant sector and the food and hospitality. That then feeds its way through to the base this year.
Yeah.
And that year-on-year increase. So if you look at the actual chart of the year-on-year increase, around 70 basis points of that increase is just that effect working its way through. Everything else is relatively well behaved, and I suppose that's why at this point in time people need to, i.e. those economists that we speak to, that we listen to delve into the data and give us that view on whether it's core prices, those things that we're all consuming on a regular basis, that are increasing or not, because the headlines are around certain areas, but for inflation to be sustained, it needs to be a general increase in the price level across the whole piece of the goods that are out there, and that's not what we're seeing just yet. It's very much tied to some of those bottlenecks. The other one, the one that's quite topical at the moment, is just energy prices, and where they're going, particularly not just here in the UK in the spot market, but in Europe in the spot market, because of what we've seen with natural gas prices going up. The fact that we use a lot of renewable sources of energy today, but there's not been much sun over the summer months.
Not much wind.
Not been much wind either. And so
Yeah.
you've got a shortage of those sources of generation at this point in time, which is, along with a number of other factors, causing spot energy prices to increase quite significantly, which will feed in at a point in time. But then we'd probably argue that some of that is temporary. We'd like to think that the wind will pick up as we move into winter.
It's very challenging, the whole inflation dynamic, because there's so many moving pieces. And I think what's quite interesting is that used car prices that has really surged. You've actually seen that start to ease off. And so that plays into that transitory nature, but it does change month on month. The big numbers will grab the headlines, but you have to really look into the details, and we discuss inflation a hell of a lot between us.
You're right, Paul, about getting into detail, and you know, Jeff's note this morning about the morning market updates. We're talking about the UK retail sales data and the fact that food store sales are down, but there's a reason for that.
It's a bizarre one, isn't it? You think retail sales, it would capture all of the activity in the economy, but the UK number doesn't capture the good things in life. us going out and eating in restaurants, going out to a bar or whatever. It's not there in the data. Whereas what is in the data is food. We're not buying as much at a supermarket because people are going out.
Yeah.
But that looks like a negative in the retail sales, but you don't have the offset. And I think that's just the real challenge, isn't it, with data? There's different ways of calculating so many things.
Yeah.
And it's the definition that different countries use for their inflation number, their retail sales number, even their GDP numbers, how they seasonally adjust it, etc., etc. There's just so many ways of, what is the right word, manipulating data to make it fit a story, fit a narrative that you want to use. I'll not talk about the US inflation at the headline level. I'll talk about it at the core level. It's 1.3% lower by doing that. Quite helpful in some people's narrative, in others it's not.
The final point on inflation before we move on, we're talking about UK inflation, we're talking about US inflation, and you would think that there's a common approach across the inputs into what is actually the inflation figure, but that's not right, is it?
No. I even this week when I was looking at the Office of National Statistics, their UK inflation reading, and thinking about which one of these am I going to talk about in morning markets, because there's 3 different levels, and I'm thinking, well, if I go into the one that looks at including household costs, I'm going to have to explain that. I'll just stay with CPI. I'll use that as the one that everybody's familiar with. And then you go off to the US. Households are treated differently. Owner-occupier rent, how that feeds in or doesn't feed in. And then, the ECB as well, they've spent, I think, 18 years of trying to think about what's the right way to bring housing costs into their inflation number. At the review that they did a couple of months ago of bringing in the asymmetric target, they've brought in a measure of housing related costs, but they're not sure if that's the right one yet. So 18 years of judgment, still not sure. But I suppose that's an economist, isn't it? Economists they deal in abstract maybe at times, shall we say.
And add a European economist into the mix.
That might be a more challenging mix.
Yeah, there's another 18 months to go on that one at least. Inflation is key, and as Chris put it well before. The way to overcome inflation is to get into asset-backed securities, and that's very much what you've been doing. And Paul highlighted before, buying into Japan, buying into Europe, and looking at trends, momentum-driven approach. One thing that comes through is when we've got strong corporate earnings. That investors do get rewarded through that, and the appetite now looks like it's moving into further income distributions through dividends and share buybacks. How will we see that coming through? I'll ask you about the portfolios, and then Paul can answer about how that will affect growth aligned the funds that Paul manages.
Yeah, sure. So basically, you can get shareholder returns in 2 different ways. You could get a dividend return, which is basically where you receive a dividend. So if you think about that in some ways, maybe like interest on a bank account, it might be a very simplistic way of thinking about it, but basically a cash payment for holding shares in companies. So dividends tend to be more prevalent in areas such as the UK, less prevalent in the US. And then you've got also share buybacks as well, where the company buys shares. So both of these ways enhance shareholder returns. So these are very important things that we look at overall. Now, if we think about the income environment overall, what you saw in the pandemic is a lot of companies either suspend paying dividends. They did that for 2 reasons. The first reason is because they couldn't afford to pay them, because maybe the company was in trouble because of the pandemic. Or the second reason was actually maybe they thought it was more prudent not to pay dividends at that point, because they wanted to hold that cash because they were nervous around how long the pandemic was going to last. Now, what you've seen since the kind of eye of the storm, if you like, say sort of March 2020, is actually you started to see dividends come much more on stream. And actually that's been really beneficial for the True Potential portfolio proposition. So we've got obviously normal standard non-income portfolios which do benefit from that. We've also got specific income portfolios as well, so available within Cautious and Balanced, and they're really benefiting from that right now. So you're seeing that higher equity income come through. As well as that, you're also seeing more share buybacks come through. So I think it was Microsoft announced it was $60 billion, worth of share buybacks, which is a phenomenal amount. And that just shows, again, what we're seeing in the markets today, which is fantastic. We've got Close Brothers, their biggest holding is Microsoft. So they've got, I think it's around about a 3% holding in Microsoft right now. So that's been really, really beneficial for them, and therefore really, really beneficial for the portfolios. But I think the key is that actually, we're still not there yet. There's still more to go with that dividend recovery overall. We see dividends potentially recovering probably into 2022, maybe into early 2023, depending on which different region that you look at overall. So actually, there's still potential for strong dividend growth to come through, just as part of that pandemic recovery, as well as obviously normal dividend growth that you'd see from companies.
And it speaks to the recovery and the strength of the economy that we've seen, which feeds into corporate profitability. And then the company's thinking about what are they wanting to do with that capital, that excess capital that they have. And as Chris says, we've seen that dividend come back, but we've even seen a number of companies pay special dividends over the past couple of months, which it's slightly ironic that they over-raised, if that's the way to describe it, in terms of in the pandemic, in the eye of the storm, as Chris described it. They went to the market, they raised capital to protect their balance sheet, to protect the business, yet now they've got excess capital and are now returning that to shareholders, which is great to see. It gives you that idea of the confidence that those management teams have, those boards have, in the direction of their businesses going forward, and we're seeing that come through. It also plays through, I think, to some of this positivity that we've seen around Japan over the past couple of weeks. It's maybe for Prime Minister Suga, it's not a great thing that he's left and the market suddenly rallied a lot after, but it's an expectation of positive change and a further movement, I think, around corporate governance in Japan as well, which could allow some of those things around buybacks and increase return of dividends to shareholders. And that it is an important part of overall return, but it's also an important driver of stock prices. Provides support, it provides another means of valuation support to stock prices.
I think, Jeff, before we leave this topic, I just want to get down into why are buybacks good and what are the mechanics of buybacks? Because we talk about it, but not everybody will understand exactly what's involved in this. Yeah,
so it's a complex topic, and there are differences as to why buybacks are favoured in the US versus why dividends are favoured in the UK, and it all stems from that taxation impact and how that feeds its way through for a corporate. In the US, the preferred way of returning capital has been via share buybacks. What does that mean? It's effectively companies retiring, buying in shares in the market. That has the impact of reducing their share count, and that then is a positive in terms of the thinking that through from a valuation perspective.
So basically you've got the same value but less shares.
Yes.
So those who are holding the shares have got a greater value.
Exactly.
Yeah, the price goes up.
Price goes up as a result. And that has been very much what we've seen in the US. It'll be interesting to see if we start to see taxation changes to fund some of the plans, the fiscal expenditure programs that President Biden has alluded to, whether they change the dynamics for taxation on share buybacks in the US. There was an article in the paper over the weekend that looked at a number of senators seem to be coalescing around a bill to put through that would see tax added to share buybacks. May see them saying, well, actually returning via dividends is slightly better. One could argue that dividends is a better way of returning capital to ordinary shareholders as opposed to the overall corporate entity.
Yes. Good. And of course with dividends as well, Chris, we had a regulatory intervention in Europe in particular which stopped banks paying dividends.
Yeah, no, it's a good point. I think, the reality is obviously the regulator is very, very sensitive around shareholder return, and particularly sensitive in the banking sector. So what you saw is actually, and it was in Europe, I think it was in the UK, I think you actually saw it in the US as well. Basically the regulator stepped in and I'm trying to think of the words they used, but they didn't sort of stop them from paying dividends, but what they said is they thought it was prudent for them not to pay dividends. Now, what that means is they're basically stopping them from paying dividends in reality. But what you've seen is that's changed now. And you've seen that come through. I think there were big payouts came through from, I think it was Morgan Stanley. I think it was Goldman Sachs as well. I think it would have been around about 6 weeks ago. Yeah. What you're seeing is really just a move back to a more normal environment. You know, we've had the pandemic, which is obviously completely abnormal for everyone's life. It's abnormal for markets, for asset prices. But what you're seeing now is basically a move back to a more normal environment overall.
I think that's why we're in Growth Aligned been overweight equities for quite a long time, because we know the fundamentals are strong. We've seen that coming through in dividends, share buybacks, and therefore it pays to be overweight equities, which we're benefiting from.
And Paul, do you think you're going to continue on the theme we discussed earlier? It'll be European, Japanese and alternative investments rather than, say, UK?
We've got a slight overweight to the UK as well. We think the UK economy is strong. It's delivering better than we'd expected, say 6 months ago, and it's good value as well. So we want to continue to have a marginal overweight, but our preference at this minute is Japan. It is Europe. We've got some active managers in Europe, and we think these more cyclical regions will do better given the rate of economic growth that we've got just globally, and that's well above trend, and that's expected to stay above trend going into next year. And you've still got a huge amount of stimulus coming through, whether that's monetary or fiscal stimulus. And so, and financial conditions are very, very favourable as well. So we certainly do prefer those areas, those more cyclical areas, and want to be overweight equities at this stage, and will continue to do so throughout this year.
I suppose it speaks into that view that we've had of this passing of the baton of recovery, and that speed of recovery moving through economies at different paces, which ties back to first in, first out, but also the speed and the rollout of the vaccination programme. If we think about 6-7 months ago, we were probably sitting thinking, what's Europe doing at the moment in terms of its vaccination rollout? But actually that's accelerated quite materially, and is now really supportive of that European story that Paul's been discussing. Japan slightly later. We go back to a couple of months ago, the Olympics, concerns around the rate of vaccination there. Again, that's pushed on quite significantly, and that's supporting alongside political change that is positive. And again, you've got a Japanese economy that's tied into global growth, and as we've discussed, we think global growth stays above trend this year, definitely, but also into 2022 and maybe potentially slightly beyond that as well. So supportive of that baton passing of growth and that growth momentum.
I think it's but it's not going to be one directional. No. There is going to be some volatility, so it's important that we have a very diversified proposition, which we do, and that's not just within bonds but alternatives. So that's where the momentum strategy is coming in for us.
I just want to touch on one thing before I ask Chris about the portfolios. You mentioned earlier the Japanese market's gone up because of one event in the political world. In the UK, we've seen a cabinet reshuffle over the last couple of days. Has that had any effect on UK markets?
No.
Everyone's shaking their heads on it.
It's a fascinating one where if we think about how politics is impacting certain markets, so we think about politics, Japan, it's been a real issue. We look at China, politics, regulatory change driven by the political environment is really impacting asset prices and impacting the market there. In the US, very much focused around what President Biden is trying to get through from an infrastructure package. So there's evidence where the political backdrop is impacting markets, is impacting asset prices. For some reason in the UK, there's not that linkage just doesn't seem to be there at the moment. I mean, what that means for Boris, I'm not sure, but there does seem to be a void in that reaction function
Yeah.
at this point in time.
There's a different political dynamic in China as well, where re-election is not an issue at all. You don't have to pander to the public. But there's things happening within the Chinese market. You know, the recent one was Macau.
Yeah, no, it's just rolled through, hasn't it? We've seen regulation roll through from the technology area, from the ride-hailing apps, Didi, etc., into the education companies in August, and now we move on to the next thing, which is Macau. For those that don't know, Macau is the only area in mainland China where you can effectively gamble. It's been a concession-based business model for a number of casinos over many years, and again, it's always been a risk. People have known that the concessions could be challenged. It looks as if the CCP are having a think about whether they're appropriate or not going forward. So it's just another one of those regulatory issues. And you know, if you look at the impact that it has, it's very material. Those operators that are tied into that theme have seen their share prices fall 20 to 30% this week. So quite significant impacts from a market perspective from regulatory change, or the thought of regulatory change.
That's right. The anticipation is what's driving things.
Driving it,
Now, Chris, Paul's gone through what he sees happening within Growth Aligned and Global Managed, the funds that he manages. With the portfolios, I know you've got planning meetings today and into next week. You know, what do you see happening in the rest of the year as we head out of 2021 into 22?
Yeah, sure. I mean, I think if we look through the rest of the year, I think the reality is we still see strong economic growth. I think when we think about the areas that we're positive on, you know, it's actually very similar to what Paul said. So the areas there are what we call the more cyclical areas. So there'd be areas such as Europe, Japan. They're the areas that we tend to be more overweight. I think if we think about, you know, what are our thoughts moving forwards, you know, the reality is this year has been exceptional for returns for the portfolio. I'm incredibly pleased by the returns that we've delivered this year. I think if we look forward, I think there's still room to deliver further positive return. And the rationale for that is, in some ways, maybe something that Jeff said around, you know, passing the baton. You know, the reality is there's still a lot of regions that are really in recovery mode.
Yeah.
You know, arguably the whole world is still in recovery mode, but there's a lot of regions that are there that still have a lot of what we call catch-up potential. So for me, you know, I'm actually quite positive as we move through this year into next year. You know, I think we've got a lot of really strong ideas in the portfolio. I think we've got managers who I believe are genuinely very, very innovative. You know, Growth Aligned is one of them. Paul's obviously talked about the alternative positions, that trend position that he's looking at. We've got other managers that are looking at different ways of sourcing return outside of equities and bonds. So again, you know, if you were to see markets maybe trend sideways for a little bit, you could have other assets in there that will provide you good returns. So for me, it's all about having that diversification. So diversification by asset class, diversification by geography. And this is a bit of a sales pitch, but genuinely, you know, what I think is unique at True Potential is diversification at manager style, which you don't get anywhere else. I think for me that really is key moving forward, and having those different managers with different styles, different specialisms, different ways of thinking about making return overall is the best way moving forward.
You know, you're right in what you're saying. We'll be repeating what was being said on previous podcasts.
Yeah, I always say the same thing, but it's because it's important.
Chris, there'll be some people watching this for the first time, so it's not repetition for them. But the idea that we had when we set up the portfolios on a multi-asset basis is that there is always somewhere to go.
Absolutely.
You know, that if equities are looking attractive, we can move more into equities. If we think the bond market's right for clients, we'll put more money into the bond market. So the joy of having multi-asset portfolios means that we can look at opportunities rather than worrying about what's going to happen here, what's going to happen there. There's always something in front of us, and it's forward-looking.
It's the granularity of those opportunities. So by virtue of the types of managers that we work with and the access to product and solutions, and even to build solutions that they have, it's not just about thinking about it in that narrow sense. It's like, how do we target that specific area, and those managers can go off and find that. And that's what's, I suppose, the beauty of the diversification, but also working with the managers that we do work with. They've got the freedom to do that. They've got the resources, they've got the expertise, they've got the skills to go and identify those opportunities and exploit it within the portfolio in a very, very efficient way for our clients.
I think it's just the point as well that you were saying, Mark, being forward-looking, really important. Yes, we're looking at the next 3 months, but also thinking about next year.
Absolutely,
What could do next year. Keep an eye on emerging markets, just of how they've performed, where they could get to in the vaccination front. That could be somewhere where we move to. Think about 2022, so we have to be forward-looking, which is important.
Yeah, and I think we've done well on the podcast. I'm going to spoil it now by saying COVID, but it's still is the effect of COVID, and how we move through it is important going forward. And for Chris, we could make Chris's job a lot easier by saying, right, you rebalance the portfolios back to where they were. Back to where they were when we launched them in October of 2015, and that's all you have to do. But it's a little bit more challenging for Chris and the team, because we say, no, that's not good enough. This going back to the black box is not right. You've got to look forward, and you've got to position the portfolios for where we see opportunities in the future.
I think just maybe to add to that, that's why diversification is important, because we haven't used the COVID word, but you can see the impact coming through in markets on a daily basis. It does impact the narrative about how people think. It impacts the economic reality. So if we look at China, over the course of August, we saw a very, very poor retail sales number for China, up 2.5% from what was it, 8.59% in July. Very much focused in on the restrictions that they put in place to dampen down the impact of COVID in that economy, even though they've got 1 billion people vaccinated. And that can be seen in, Paul was mentioning earlier, the data in the US. You look at airline prices for August, they were off about 9%. Because fewer people were travelling, because of the rise of the Delta variant. So it's there, it's with us. It will impact activity. But again, it speaks to that need to have diversification in the portfolio, and to use diversification to your benefit. So that, it might be an impact, it might impact there, but we've got other alternative exposures within the portfolio.
Okay, that's great. Well, I think we're just about drawing to a close now. When we got the brief for this week's podcast, Graham said you'd like some laughs and banter. So we invited Paul along. But the usual way we close is just to ask everybody what they're up to this weekend. So, Paul, we'll start with you.
Well, I'll be going for some pints with Chris tomorrow and some of the other of the team, and then probably recovering on Sunday.
Good.
Contributing to the economy. That's
Gets me out there.
Unrecorded in the data, but it'll be there.
So expect a huge spike in the food and drink prices in the inflation numbers next month.
And I think what we'll do is we'll also record an alternative ending to this that Chris can show Moira, which says Chris is not going out this weekend.
She knows. She's, but no, it should be good. I haven't been in Newcastle for a while, and I haven't been out with the team for a while, so it's going to be quite nice just having a few relaxing beers on Saturday afternoon.
That sounds good.
A few being?
A few 7, isn't it?
7.
Classic few.
And Jeff, yourself?
I've got a few things on with the kids. It's good to see them back to school, back to doing most of their clubs and things. So we've got a tennis match, first tennis match for my son this weekend, so we'll see how that goes.
Very good,
yes.
Very good. And for me, I've got a football match tonight. We're not going to say too much about that. I won't say too much about that.
No prediction on the result then? No.
Well, I would have a prediction, but I would be disloyal if I am
not to share.
Not to share.
Okay.
So everyone, thank you very much for watching. I hope you've enjoyed it. Please continue to watch the True Potential Do More With Your Money podcasts. And from me, Mark Henderson, thank you very much.
Subscribing to the True Potential YouTube channel is quick and easy. Simply go to the channel on your desktop or through the YouTube app on your phone and click the subscribe button. You can then press the notification bell symbol if you wish to be notified as and when new videos are released. Doing this is a great way to keep yourself updated with market developments and personal finance insights. Thank you to everyone who has subscribed, and we look forward to continuing to help you do more with your money.